All right, if you're a business owner in Canada and you're thinking about making that next big equipment purchase, then you are in exactly the right place. Today, we're going to pull back the curtain on the whole world of equipment financing. We'll look at what's going on in the market, what lenders are actually looking for, and most importantly, how you can get that big yes.
So you're eyeing that brand new excavator, right? Or maybe a state-of-the-art CNC machine, maybe even a whole fleet of trucks. You know it's going to boost your bottom line, but man, dropping that kind of cash all at once, that's a huge decision. The real question is, in today's economy, how do you even get it financed? Okay, let's get right into it.
I want you to think of this whole process kind of like a funnel. We're going to start way up at the top with the big economic picture. Then we'll narrow it down to the lending industry itself. And finally, we'll land right on your desk with your application. You're going to see exactly how these huge economic forces trickle all the way down to affect your deal.
First things first, let's set the stage. Because to really understand the loan you're applying for, you've got to understand the economic world that loan actually lives in.
You know, it really all starts here, with the Bank of Canada. For the last couple of years, they've been in this massive fight against high inflation. Their sweet spot, their target, is a nice, predictable 2%. And their number one weapon in that fight? It's interest rates. And those rates directly impact how much it costs you to borrow money. And that's where this number comes in. See, after a long period of hiking rates up, the bank has finally started to make some cuts. The prime rate has now dropped to 5.95%. For a business owner, this is a huge deal. It means the cost of borrowing is, at long last, starting to come down.
In this quote just hits the nail on the head, doesn't it? That hesitation a lot of businesses have been feeling, well, it's starting to melt away. A lower rate can be the green light you've been waiting for. The signal to go ahead and invest in that equipment you need to grow without putting a crazy squeeze on your cash flow.
Okay, so we know the cost of money itself is changing. But what about the companies that are actually, lending it out? Let's zoom in a bit to the lender's landscape, because things are really shifting here.
Now here's where it gets really interesting. People in the know, the experts in the field, they're predicting a major shakeup in the equipment finance industry. We're talking about big players buying up the smaller ones, and that directly changes the kind of options that are available to you.
And listen, this isn't just some theory. It is happening right now. As we speak, we've seen National Bank snap up Canadian Western Bank and its massive leasing division. ATB sold off its equipment finance arm, and so did Laurentian Bank. What this means is that fewer, bigger companies are starting to control more and more of the market.
And watching over this entire chess game is OSFI. That's the Office of the Superintendent of Financial Institutions. Think of them as the main federal referees. They're the ones setting all the complicated rules that banks and lenders have to play by to manage their risk.
So what does this actually mean for you, the person trying to get a loan? It means all this consolidation is happening in a super tightly regulated environment. That pressure from OSFI makes the big banks and lenders extra cautious, which, you guessed it, directly influences who they're willing to lend to and what the terms are going to look like.
Okay, now we're getting to the real heart of it all. How are these deals actually decided? I want you to forget everything you think you know about typical bank loans. In this world, the equipment is king.
This quote from a Canadian business forum absolutely nails it. A lender isn't just financing a hunk of metal. They're financing its ability to make you money. The entire approval process is built around that one simple idea. It's way less about your company's spotless 20-year history and way more about the value and the usefulness of the asset itself.
So how does a lender officially call dibs on that piece of equipment? They do it just something called the PPSA. Seriously, just think of it as the official dibs system. It's the rule book that lets a finance company go on public record and say, hey, everyone, we have a financial stake in this specific truck right here until the loan is totally paid off.
So this process of making those dibs legally binding is called perfection, and it happens in 3 key steps. First, you've got attachment. That's basically you signing the loan agreement. Simple enough. Second is perfection. That's the lender going into that PPSA system and officially registering their interest for the whole world to see. And finally, that sets the priority. It's pretty much a first-to-file rule that decides who gets their money back first if things go sideways.
All right, let's get super practical. You know the economic climate, you get the lender's mindset, so what do you actually need to show them to get your deal stamped approved? Lenders are really zeroing in on a few key things. First and foremost, the asset. Is it a good piece of equipment? Does it hold its value? Is it easy to resell if they have to? Next, they look at your business. Have you been around long enough to have a real track record? Is your revenue stable? Or if it's been up and down, is there a good story to explain it? And that brings us to the final piece. What is your story? Can you clearly and simply explain why you need this machine to grow your business?
And this brings us to the paperwork, and I'm telling you, do not underestimate this piece of advice. Trying to save a few bucks on bookkeeping is such a classic mistake. Investing in a pro to get your financials clean and organized, it's not an expense. It's an investment that will pay for itself a dozen times over with better rates, faster approvals, and a whole lot less headache for you.
Now, let's talk about the flip side for a minute. Because understanding why deals get turned down is honestly just as important as knowing how to get them approved. Let's look at the most common red flags.
Sometimes it really isn't you, it's them. Your deal might just be a policy mismatch. You brought a square peg to a round hole for that specific lender. But a lot of the time, the issues are avoidable. Bounced payments or recent overdrafts, those are huge red flags. Same with trying to finance a piece of equipment that's way too old or super specialized. And if it's a private sale, oh boy, any messiness with the ownership papers can kill a deal right on the spot.
Okay, so here it is, all laid out side by side. On the left, you've got the signs of a winning application: clean books, solid asset, a clear story for growth. And on the right, the deal breakers: messy bank statements, shaky collateral, and a poor payment history. Just treat this as your personal checklist. Your job is to get everything on the left in perfect order before you even think about submitting that application.
So, if you're going to remember just one thing from all of this, what should it be? It's actually pretty simple. In the world of equipment financing, the strength of the asset you're buying and the clarity of your story, that is what will ultimately win you the day.
So there you have it. You now understand the entire landscape, from the Bank of Canada's decisions all the way down to the fine print on your application. You know what lenders are looking for, and you know the pitfalls to avoid. So the only real question left is, now that you know the rules of the game, are you ready to go out there and make your case with confidence?